Welcome to Agrivisions, a program of First Dakota National Bank. I'm Michelle Rook, back with Nate Franzine, president of the Agribusiness division. Nate, at their December meeting, the Fed cut interest rates another 0.25%. That was what was expected, but it looks like they're going to stay that way for a while.
Yeah, that's certainly the indication they gave. Certainly in Chair Powell's remarks after the committee action, he talked about rates now being in the range of neutral. And when we have inflation a little higher than they'd like and labor data showing a little bit more stress in the labor market than they'd like, neutral is probably where they want to be, because then they can act either direction from there based on changes in those two numbers going forward. So he did use the term, we're in the upper range of neutral. So that tells us there might be a little bit more rate lowering to come, but probably not a lot. I think it's important for farmers and ranchers out there to maybe start having the mindset that we're close to where we're going to be for a while on the short-term interest rate levels.
However, that's not the case with long-term rates. They're actually going up, aren't they?
Yeah, the long-term rates have inched up a little bit here after the Fed's last couple of drops. And, in my mind, that's the normalization of the yield curve. And what do I mean by that? Well, a normal yield curve, the longer the rates are out there, the higher they get. That's a normal yield curve. We had an inverted yield curve through a lot of the pandemic time and a lot of the out of the normal environment we've been in the last several years. And I think what we're seeing is just normalization of those. Probably the best way I could say it is, if you're sitting on a bunch of money and you want to put it in a CD, the longer the CD, the more you expect to be paid. You're not going to put your money in for 5 years at the same rate you could get on a 6-month CD. If that was the case, you'd just tie it up for 6 months and keep your options open. The yield curve works the same way, right? Those people funding the long end of the yield curve expect to be paid a little bit better. And I think that's what we're seeing here. There's a lot of dynamics that go into that, though. Our national debt level, foreign investment, assessment of risk. So it's complicated, but that's what I think is happening.
Thanks so much, Nate Franzine with First Dakota National Bank and today's Agrivisions.